The prices of infrastructure and utility stocks have taken a beating in recent years, so the yields are looking pretty sweet right now. Today we'll look at two funds yielding 8.2% and 13.5% and why I recently added them to the portfolio. I bought the Reeves Utility Income Fund, ticker UTG, a while back and it's yielding 8.4%. It's a decent fund, but I'd like more exposure to these boring but consistent income producers. AI chips are hot right now, but utilities and infrastructure is what keeps the lights on and the freight moving. We'll look at two UTG competitors today and I'll compare their total returns with UTG to see which of the three has delivered the best results. You'll see a yield of 9% for ASGI on some websites and 13% on others, so which one is correct? The difference can be explained by the formula they use and ASGI's recent change to their distribution policy. If the website divides the trailing 12 months of distributions by the price, they'll get 9-ish%, but that ignores this recent jump. In May 2024, ASGI announced that they would increase their distributions from 9% of NAV per year to 12% of NAV per year. If you annualize this new higher payout of 21 cents in June, the yield comes to 21 times 12 months divided by the current price of $18.63 equals 13.53%. So the distributions are consistent and they're high, but there's not that much history. This fund has only been around since 2020. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, because now they pay for everything. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, or in today's case, slightly more than 12%. ASGI is an infrastructure fund, so it holds companies focused on areas like roadways, railways, water treatment facilities, cell phone towers, electricity, etc. For example, they hold Canadian Pacific Kansas City Limited, which is a railway company. The price appreciation on this chart going back to 1994 looks more like a tech growth stock than an infrastructure business. Income for the fund comes from dividends and capital gains. A good dividend example would be Verizon, which pays 6.5%. That's in the portfolio. The Canadian railway company I mentioned pays almost nothing, but when ASGI sells stocks like that one, the capital gain becomes part of the distribution. Apart from the yield, here's what I like about ASGI. Just over half the portfolio is based in North America, including Canada, as we saw earlier. The other half is spread mostly around Europe, Latin America, and Asia. I bought this fund for diversification, so that's a plus. The Magnificent Seven is driving most of the market's returns, which is fine, but I don't want to rely entirely on those 7 tech companies to pay my bills. Leverage isn't necessarily good or bad, but at the moment it is expensive. I wouldn't want all of my funds leveraged, so the absence of leverage in this fund is a plus. When, or perhaps if, the Fed cuts rates, there's some upside for infrastructure companies. Power plants and railways, they're very capital intensive, so they typically need a lot of debt to grow their business. Lower interest rates would make growth much cheaper. Here are the risks and concerns I have about ASGI. The recent distribution increase looks great, but it wasn't the result of a bump in investment income. It was just a change in the distribution policy announced in May of 2024. If the NAV declines, the distributions will fall. I'm assuming that this is likely, but as long as my yield on cost remains above 9% and the NAV is reasonably stable, it could bounce up and down a little bit, this fund will be doing its job. In other words, instead of spending the entire 13.5% yield, I'll be reinvesting almost half of it into other income investments for a rainy day. The net expense ratio of 1.65% is high. Actively managing a portfolio of 60-ish companies around the globe isn't cheap. ASGI is a closed-end fund, so it can trade above or below its net asset value. In this case, it's trading at a 7% discount, at least as we record this. Historically, it's traded as low as a 16% discount, so 7% isn't a bargain, but it's better than a premium. The discount has been shrinking recently, most likely because investors like that recent hike in distributions. The other fund we'll look at today comes with a little less risk and a lower yield. HTD is currently yielding 8.2%. What I like about this fund is the history of distributions going back 20 years to 2004. There was one cut from 14 cents to 9 cents after the 2008 global financial crisis, and eventually it returned to 14 cents, where it remains today. No cuts during 2020, which is good to see. Not a spectacular distribution history, but at least we can see how the income held up during challenging times. These distribution charts came from Snowball, but I mostly use Snowball to keep track of my current and future income. I can visually rank my portfolio by current yield, see yield on cost, and know exactly when the next dollar will land in my account. There's a link in the description for a free trial and a discount. Both of the funds we're looking at today contain utilities like electricity, water, and gas, but for HTD, it's a much larger focus. Utilities comprise 31% of ASGI and 51% of HTD. Having said that, it's not a pure utilities sector fund. The next largest group of holdings is actually financials, a completely different sector. And that brings us to a key differentiator between ASGI and HTD. ASGI holds regular stocks, also known as common stock. HTD has those too, but it also has a significant number of fixed income investments in the form of preferred shares and corporate bonds. Here are some examples: Bank of America bonds and Bank of America preferred shares. These bonds and preferred shares don't offer the price appreciation of regular stocks, but they do provide more consistent income. Apart from the yield, here's what I like about HTD. This fund doesn't have the geographic diversification of ASGI, but it does offer a different mix of asset types, including the bonds and preferreds I mentioned a minute ago. The upside for rate cuts is the same as what I explained for ASGI. The utilities in the portfolio are capital intensive. On top of that, the leverage used by HTD would become cheaper if rates were cut, which would improve net investment income. Before we get into the cons, my research for today's episode came partly from the fund's actual websites, but mostly from analysis articles on Seeking Alpha. Coincidentally, my favorite analysis for both funds was by the same author, Nick Ackerman. I'll include links to his articles, which are more detailed than this video, and a discount for Seeking Alpha in the description. I use the premium level of membership, and I'm on there every day. As they used to say about another publication, I read it for the articles. Here are the risks and concerns I have about HTD. Unlike ASGI, HTD uses leverage. That's not inherently bad, although 35% leverage is at the high end of the spectrum. And that much leverage isn't ideal while interest rates are high because it's frankly so expensive. Which brings us to fees. The management fee of 1.14% isn't cheap, but it is less than ASGI, and it's within the typical range for this type of actively managed closed-end fund. If you include interest expense, though, the total expense ratio bumps up to 4.24%. The 8.2% yield is paid after that expense ratio is covered, so you don't actually see the expense. In other words, to pay out 8%, you have to generate more like 12%, and this gives you an idea of how high interest rates reduce the net income for a fund like this. Currently, HTD is trading at a 7.3% discount to NAV. That's cheaper than its 5-year average discount of 4.6%, but more expensive than its 1-year average discount of 9%. Not a smoking deal, but as I record this in July 2024, what is? Which fund has delivered the highest total return? In other words, price and income combined. Well, it depends on the time span. Over the past 12 months, ASGI has edged ahead, but if we go back to the furthest point in time that all three of these funds existed, which was July 2020, almost 4 years ago, there's a clear winner, and it's HTD. It easily led the whole way. I bought both funds recently, and combined, they now make up just under 4% of my portfolio. I wanted them for diversification, and I don't intend them to ever be in my top 10 holdings. By the time you watch this video, it's possible that all the numbers I just quoted are out of date. So if you'd like to see my current investments, click the link in the description and you'll receive a PDF of my portfolio. It's called an Armchair Insider. You'll also get updates when the portfolio changes, and it's free. ASGI is a little riskier than I'd like, but the yield is more than I need. HTD doesn't provide as much income, but has delivered a higher total return. And when you blend them together, you get an average yield just over 10% and less risk than if you just bought ASGI. These funds won't outperform the market, but they deliver some decent income. They also provide diversification outside the usual growth stocks that most of us are, frankly, overweighted in. High interest rates are challenging for utilities and infrastructure, But as these yield history charts show, the yields on these funds are higher now than their historical average. In many ways, now is a pretty good time to be an income investor. I don't know why more websites and brokerages don't offer these yield charts. They really help you get some perspective on where the yield is now compared to where it was. If you want a brief summary of other stocks and funds in my portfolio, you can watch this playlist. That wraps it up for this look at ASGI and HTD. More Armchair Income coming soon. Armchair Income.